Picture this. You wake up tomorrow, open your brokerage app, and see the silver price frozen. No ticks, no bids, no offers. News headlines start coming out. COMEX suspends silver trading. Temporary halt in precious metals futures market. Your ETF stops updating. Your broker won't let you place new silver orders. Social media goes insane. Everyone is asking the same thing. What happens to my silver if the main paper market suddenly stops? Welcome back to Data Over Hype. Thanks for being here. Before we get into it, especially if you're new, I need to be clear. I don't sell courses. I don't sell mentorships. I don't run a private group. I don't sell trading signals. If anyone uses my name or this channel's name to offer you anything, block them. I'm only here on this channel and on the official links in the description. That's it. I'm not here to sell you hype, fear, or greed. I'm here to walk through how the system actually works so you can think for yourself and make your own decisions. In this video, we're going to walk through a scenario most people never think about until it's too late. What happens if COMEX halts or radically changes silver trading in a real crisis? I am not saying this will happen tomorrow, but I want you to understand the mechanics and the knock-on effects so that if we ever wake up to a halt, you're not staring at a frozen price screen with no idea what it means. First, we need to understand what COMEX actually is in this story. COMEX is not the silver market. It's one major futures exchange where silver contracts are traded. Those contracts are used by hedgers, miners, refiners, industrial users trying to manage price risk, speculators, funds, traders, and algorithms trying to profit from moves, arbitrage players, people who move between futures, ETFs, OTC, and physical to keep prices in line. Because so much hedging and speculation runs through COMEX, its prices are used as a reference. Dealers quote based off it, ETFs use it for NAV, and even physical trades in many places anchor off that screen price. So when people say, if COMEX breaks, silver breaks, what they really mean is, if that reference system fails, all of the other layers that depend on it go into shock. Now, how could trading on COMEX actually stop or change? There are several possibilities, and they're very different in impact. First possibility, a temporary halt due to volatility. Exchanges already do this. If price moves too far, too fast, they can trigger circuit breakers, trading pauses, order books reset. This is disruptive, but it's still within the normal rulebook. After the halt, trading resumes, maybe with wider margins and stricter limits. In that situation, your positions are not gone, you're just stuck for a while. Prices can gap when trading resumes, which can hurt, but the basic structure is intact. Second possibility, a margin and limit shock. In a serious crisis, CME could jack margins way up, making it much more expensive to hold contracts. Tighten position limits, forcing big players to reduce exposure. Impose expanded daily price limits, constraining how far the market can move in one day. This is not a full halt, but it is a major change to the game while you're in the middle of it. Over-leveraged longs or shorts get squeezed. Some players can't or won't meet the new requirements and are forced out. Third possibility, delivery constraints. This is where it starts to get more serious. Imagine a situation where vault inventories are low or uncertain, logistics are disrupted, refiners can't keep up, or there are legal or regulatory issues around moving metal. In that environment, shorts who are supposed to deliver metal might have a hard time fulfilling obligations. The exchange and clearinghouse do not like that. Their job is to keep the system functioning. They have a few tools. They can declare force majeure on certain contracts. They can change what counts as good delivery. They can offer incentives to roll contracts instead of taking delivery. And in the most extreme case, they can decide to settle contracts in cash rather than metal. This is the nightmare scenario people think of when they say COMEX default. But it wouldn't look like a Hollywood movie with vaults being raided. It would look like a series of rule changes and emergency measures, where instead of getting metal, you get a dollar amount at a price someone else decides. Fourth possibility, a regulatory or political intervention. In a major financial or geopolitical crisis, regulators or governments could instruct exchanges to suspend end trading on certain contracts, ban new speculative positions, force reductions in open interest, or even close trading for a period under emergency powers. We've seen versions of this in other markets. Short selling bans in equities, export bans in commodities, trading suspensions in local bond markets. There is no law of nature that says silver futures are exempt. In that kind of scenario, the exchange might say, "We are halting trading in silver futures until further notice. Existing positions will be managed under specific conditions." That's polite language for, the game you thought you were playing has changed. So, if any of these events happen, from a volatility halt to a cash settlement event to a full suspension, what happens next to you? It depends on how you're exposed. If you hold physical silver directly in your custody, the COMEX screen price can freeze, but your metal does not disappear. However, the price at which you can actually buy or sell locally may diverge dramatically from whatever the last quoted futures price was. Dealers might widen spreads. Some might stop buying or selling until there's clarity. If you hold allocated, vaulted silver with clear title, your legal claim to specific bars should not depend on futures trading, but your ability to move, sell, or value that metal in the short term will still be influenced by how badly the pricing system is disrupted. If you are long or short futures contracts, a halt or change in settlement terms hits you directly. You might be unable to exit at the time you want, be forced to accept cash settlement rather than delivery, face new margin requirements that you cannot meet, see your broker liquidate other positions to cover shortfalls. If you hold ETFs or ETPs that track silver, their pricing and operations are tightly linked to the futures and OTC markets. In a COMEX shock, you could see big gaps between ETF price and its supposed NAV, creation and redemption processes disrupted, temporary suspensions of trading, rule changes buried in updated prospectuses after the fact. If you hold unallocated or pooled silver accounts, you're dependent on your provider's ability to hedge and source metal in a stressed environment. If their usual hedging channels freeze or move against them, their risk goes up. In extreme cases, their solvency can be at stake. The big point here is that price discovery and plumbing are intertwined. People think if COMEX stops, the real physical market will just take over at a higher price. Maybe, eventually. But in the short term, what actually happens is chaos. Different regions quote different prices. Spreads explode. Some dealers step back. Some overcharge. Some clients can't settle because their funds are stuck in a halted ETF or a frozen broker. It's not a clean, paper dies, physical wins movie. It's a messy, uncertain, illiquid period where the rules are improvised. So what can you do today while things are still functioning to prepare for a scenario like this? First, understand your own exposure. Make a list. How much of your silver exposure is physical in your possession, allocated in a vault, unallocated or pooled, ETFs and funds, futures and leveraged products? If you can't answer that quickly, that's your first job. Second, decide which layer you're willing to see frozen or changed. If 90% of your silver is held in products that depend on COMEX and broker systems functioning perfectly, you are implicitly betting that those systems will stay intact, or at least that you'll get enough warning to adjust. History says most people don't get that warning. That doesn't mean you should dump everything and bury coins in the backyard. It means consider building a core of physical or clearly allocated metal that does not rely on daily futures trading. Keeping your trading positions sized so that if they are frozen or cash settled at a bad price, you don't lose everything. Not relying on one single ETF, one broker, one jurisdiction, and one exchange for all of your metals exposure. Third, pay attention to the stress indicators that would likely flash before a full halt. Before an exchange suspends trading, you usually see wild intraday volatility spikes, repeated limit moves, rapid margin hikes, unusual statements from regulators, stories about settlement delays or delivery issues. If you see 3 or 4 of those lining up at once, that's your early warning that the market structure itself is under pressure. That is not the time to be adding maximum leverage on the assumption that they would never close this. Fourth, adjust your mindset. If silver is part of your plan as a hedge against systemic risk, then you have to think about systemic risk as more than just price going down. Systemic risk also includes trading venues changing rules, clearing systems failing or restructuring, regulators stepping in with emergency measures, differences between what your contract says and what really happens when things get ugly. If all your planning assumes that price can move, but the plumbing will always work perfectly, you're not really hedging systemic risk. You're just speculating on price. I want to be really clear here. I am not predicting that COMEX will halt tomorrow, next month, or next year. I have no special inside information that you don't. What I do know from studying past crises is that the most dangerous time to think about rule changes is after they've already happened. And the most common phrase from people who get hurt is, "I didn't know they were allowed to do that." They are allowed to do a lot. It's all in the rule books and emergency powers. Nobody reads those until it's too late. So, use this video as a prompt to read the small print on your own positions, to think through a few what-ifs, and to decide what level of structural risk you are or are not willing to carry. And as always, nothing in this video is financial advice. I'm not telling you to buy, sell, or hold anything. I don't know your situation, your responsibilities, or your risk tolerance. My goal is to help you see risks that don't show up on a simple price chart. If you've watched this far, I want to hear from you. If COMEX announced a temporary suspension of silver trading tomorrow, what percentage of your current exposure would be directly impacted? And would you be forced to act, or could you ride it out? Drop a comment and start it with either "I'd be stuck" or "I'd be okay," so I know how you see your own setup, and tell me what you plan to change, if anything. If this kind of breakdown helps you think about structure and plumbing, not just candles on a screen, consider subscribing to Data Over Hype and turning on notifications. We'll keep looking at silver, gold, and the macro backdrop with as much honesty and clarity as we can. Use your own brain. Stay within your limits. Don't follow anyone blindly, including me. Thanks for watching. Take care of yourself, and I'll see you in the next video.